Hello, everybody. Welcome to Trading with Livevol. This is Stefan Choi, and this is where I use my Reg T account to show you guys how I trade through LVX. So there isn't much going on. Let me just show you my account real quick. This looks like I'm up $5 grand, but it's basically just marks, so it's nothing. In fact, I'm actually losing in Citigroup. Just show you what I have. It's nothing big. They're all just decaying, and they're going to be zero soon. But these are just marks. So in general, the market has been just in standby mode, I feel like. SPX, let me update it. It's pretty flat. If you look at the VIX, basically the VIX is pretty flat. Although like here, just like the SPX, either you're going to actually go up or go down, depending on when I look at all the stocks right now, they're pretty much in a standstill, and the volatility is pretty much neutral. Some of the things that I have been looking at is American Express. So if you look at American Express, the stock price has gone down recently of two bad news. So today they had some court ruling that went against them. And then, but more importantly, a few days ago, they basically ended their exclusive relationship with Costco. This, I think, is pretty material since for me, I go to Costco a lot, and now that Amex is no longer going to be the carrier, I'm probably going to switch my credit card to Capital One Financial, right? So basically my thinking is that's not good news, but it's not like American Express is a bad company. I think it's a pretty solid company. As you can see, it's pretty much come down to October lows, October price level in 2013. And basically, I wanted to talk to you guys a little bit about when there might be a good time to put on a buy right? So if you look at the volatility down here, and let me just do a shorter term, you can see it's pretty elevated. Usually it gets elevated like before earnings. But this time around, because the stock went down so rapidly, basically the volatility spiked, as you can see here. So if you look at the stats, right now it's at pretty much at the 66th percentile. So what a lot of times you can do is you can buy the stock here, and let's say, I'm gonna actually look at the January. So it's almost a year away, so percentages, you can you can maybe try to sell the January 80s, right? So if you sell the January 80s for about 535, right, your break even will be like 72.90 around there, right? Because you're selling a call, you're buying stock. Basically what it does, and let me actually put that in there. Let me, I'll buy 100 shares, and I'm gonna sell one call here, okay? So this is pretty cool. You can just do this, and then you say, you can analyze it, right? So right now I don't have any position. So let's say position and SIMs, right? So this will be my break even, but obviously this is currently, let's say I actually go to, right? So this is more like my break even, right? So right now, if you look at it, my break even is going to be right around here, right? Around the $73 range, and basically above, 80, I'm pretty much just going to flatline. But why this is good is if you did that, basically you will be cushioning yourself for about, a 6.5% move down on the stock. So even if the stock goes down 6.5% from here, which is already down quite a bit, right? You can actually still break even, as well as if it stays the same. So let's say American Express cannot recover by just kind of go sideways for a whole year, you make about 6.5%, and going, if it went up, basically you'll make the 5.35 or something, whatever you sold it for, plus the difference between this and the strike price, which is another $1.80. So $1.80, that might be like a little over $7, right? Could be like, like 9 point some percent, right? The exact numbers is not as important. I just kind of want to illustrate if you were, if you weren't into, having to like be super bullish, and you have a longer term outlook. So you want to trade something for a longer period, but you have a day job and you don't have to look at it day in and day out. You like American Express, so maybe this might be a stock that you would have bought right now anyway, considering how much it sold off. So let's say you're thinking of buying it because maybe you thought it might go up. Then you can actually, this would be a good candidate because you can buy the stock, sell a call against it. You have the cushion down to around the $73 level, and you have the upside of around 9%. Now, let's say you didn't think the 9% was that much, right? Then you can actually say, you know what, I don't want to sell those. I want to sell these, right? Or 85. So if you sold the 85s, you'll get the 340. Plus, you'll have upside up to 85. So that's $7, $10, and now you're looking at like 12.5, 13, 14% return on that trade. And if you go to the position analyzer, basically, this is what you'll have, right? So if you actually move it forward, now your break even is much higher, right? And then and your downside is your break even is a little bit higher. So it's not 73, it's around 75. So you can kind of mess around with this kind of stuff, and once you like it, you'll have this thing called sim to complex. You can actually click it, and it'll actually populate both orders, and then you can send it. So it's pretty cool how you can do it. This is a perfect kind of trade to do if you want a specific return on your investment. So American Express also has a 1.3% dividend. So if you did it this way, and let's say what you were looking for is a yield in your investment, you can pretty much sell the 80 level calls and basically receive the 535 in over the course of 1 year. Plus, you'll get 1.3% in dividend, which is, I think it's right now it's a little over $1. So you will be collecting $6.35 on this 78.20, right? So what's that? 6.45 divided by 78.2. You collect like 8% return combined with the dividend and the calls. So if American Express stays here or goes higher, let's just say if it stays here, you'll make that amount. So it's almost like putting it away in a bank, except you have a little more upside, but you also have unlimited downside after your break-even point because you're just owning naked long stock, right? Because these calls will only mitigate up to $5, and beyond that, it won't really help you. So what a lot of people do is they'll say like, hey, you know what, 8% return in cash is pretty good. So if you had X amount of dollars in your account and you wanted to return money, that's kind of the stuff you can do, right? Or you can buy, like a lot of times people buy dividend heavy stocks to kind of give them cash returns, such as McDonald's, AT&T, Verizon. All those companies pay a very high dividend, higher than 3%, and right now in the money market you basically get nothing. So this is a different way of actually doing it. So let's say you were a little more aggressive and you didn't want to sell the 80s, you would keep selling the higher strikes. If you were less aggressive, you might sell more in the money, right? You can actually sell the at the monies for 650, right? And basically, if the stock stays here, you collect 570, right? And then 120, right? Around 530, 78, 75 cents. No, 575. Sorry, 77.5. So 78 minus 25 minus 77.5 is 75 cents. You subtract that from this amount because that's the intrinsic value. You have to read it up. Intrinsic is stuff that's already in the money. Extrinsic is out of the money. So that'll leave it to like 580, roughly around there. That's the amount you would collect if the stock stayed right here. But even if it went up, you only collect 580, right? But overall, this is a great strategy to implement if, and this is a big if you were going to buy American Express stock anyway, or you were trying to figure out a way to kind of structure your investment in a way where you can get dividend returns, as well as cash returns. So if you're saying, hey, I want to yield 5% from my investment over the course of next year, this is how you can design it. So a lot of times if you had $1 million and you put in a lot of designs like this, not only can you make a little bit on the upside of the overall general market going up, but you can also make money if the market stays exactly the same, and your returns will be way better than if you just put it in a one-year CD. So this is a great strategy for those of you guys who, number one, don't want to trade every day. This one, you put it on and you just wait until next year, basically. So that's pretty easy. You do the calculation once and you put it in. And obviously, you wouldn't do this on, on some biotech stock just because it's not reliable. It can actually go to zero. You would do it on the large cap stocks, right? Or stuff that's in the, and American Express is in the Dow 30. So that's something that you would consider, or one of the S&P 500 stocks, maybe even S&P 100, right? The top 100 companies in the United States might be a good candidate for this kind of strategy. I like this strategy just because right now, I like it because it's fallen quite a bit. So it was trading around 95, 94. Now it's trading below 80. That's a pretty substantial drop. And, they're still going to do well going forward, right? So they have good fundamentals. And obviously, they're not going to do as well because they lost Costco. But it's a solid premium company. There isn't too many credit cards out there. Basically, it's MasterCard, Visa, and Amex, right? So no matter what, it might take them a little bit to recover, maybe even over a year to recover from this. But while you're waiting, you'll be collecting about 8% return on your investment, which isn't bad either. So I just wanted to point that out. The other thing is that's unrelated to this is, I talked to you guys about XOM, how I thought it was overvalued versus the oil. It's interesting that Berkshire and Warren Buffett completely sold out of his position in XOM. The exact reason, I don't know, and I don't want to really speculate. It's just, it's kind of good to have somebody back your idea or maybe have similar idea than you did. But then in the end, I don't really know, right? Because he has a lot of other stocks that are energy related. He might have just not wanted to keep all of them, and he probably wanted to sell the one where he lost the least, right? So XOM really didn't go down too much. even now, right? 102 to 90, while oil is down over 45% over the course of the year. So, so I'm looking at this, and so I want to short XOM at some point. This is the oil stock, oil United States Oil Fund ETF. You can see kind of like it opened low, but then it's kind of recovering. So I don't think I'm not sure, but once this thing starts rolling over is when I would be comfortable buying puts in XOM, and also the airliners. So they had a pretty good pop this morning. You see AL and Delta, they all had a pretty good pop, but they're selling off. So this is not the greatest of charts, because if it fails to make this, and it can't stay above the 7-day moving average, it might actually make a newer low. So I know I probably could have gotten in here and made some money, which I kind of regret, but in the end, the whole market looks like it's in limbo, and I just don't feel comfortable betting, especially since I'm a short-term trader, on where the market's going to go, right? So if I look at this at an all-time high, it just hit 2100. It can easily just roll over. Not that it'll just roll over and keep going down, but it could temporarily roll over back to like this range, like 2060, 2050, and it wouldn't really make any difference in the upward bias of the stock market. So, but to me, on a short-term trade, if this market went from 2100 to 2050, I would lose quite a bit. And if I bought puts, I would make quite a bit. The only problem is I kind of feel like the market's going to go up. So even though all this stuff makes it seem like you should maybe consider, you know, buying some calls if you think like the momentum's going to go up, or buy some puts because you say, hey, it hit 21, 20, it's going to roll over. My personal analysis is that it's 50-50, even though, you know, if I actually had to pick personally, I think it's going to go up, but I'm not comfortable enough to make any bets. So right now I'm pretty much mostly in cash, almost all of it in cash. And I'm just going to wait until some sign comes up and I'm going to trade. So, you know, I've been dabbling a little bit, but it's only been hurting me. So this month in February, I made, I think I made, yeah, so I made 40. Yeah, so I think I made like, you know, I made 7,000 or 8,000 pretty much right at the first week of February, and then ever since then I've been giving it back just because I've been doing this little stuff and it's been stupid, right? So it hasn't worked out. I made a little money on MGM, but I kind of got out early because I thought the market might roll over. So I made like a few $100, but in the end, you know, I should have kept it. But right now I'm not worried about it too much. I'm just gonna see what happens and wait for a really good signal. So one of the things I'm trying to do is be patient and not have to be invested at all times. Other than that, that's about it. I'm not sure if I'm going to be here tomorrow. I might or I might not. I'm about 50-50. But hopefully you guys do well. And I will talk to you guys soon. Take care.